Hi everyone, as I'm sure most of you already know me, I'm Corey Reeder, Chief Investment Officer with HK Wealth Management. I handle all the investment side and investment management for our firm. So welcome to our Q2 mid-quarter market update. So as you guys already know, there's a lot going on out there in the employment arena and in the economy itself. So this is a chart showing the continuing jobless claims. So these are the unemployed that are continuing to, these aren't the newly unemployed, these are the people that are already unemployed and continuing to receive benefits. And obviously looking at the historical levels that this has been at in past recessions compared to where it is today, this has been a massive shock, blowing out all of proportions, every other prior instance in this. But in the subtext below it says, while it's true that the BLS, the Bureau of Labor and Statistics, reported that the April unemployment rate was less than expected at 14.7 instead of 16%, the drop in payroll employment of 20.5 million was also less than the 22 million expected. However, Standard Chartered Bank has calculated that adjustments to the headline unemployment rate pushed the effective number of unemployed to 42 million and the effective unemployment rate to 25.5%. Worse, if one treats underemployed in line with the U6 methodology, the true April unemployment number would rise to a mind-blowing 27.5%. So this is just historical times that we find ourselves in right now. So looking at this chart, this is job openings. So these are the openings that companies post out there when they're looking for employees. And as you'll see, each time we go into a recession, obviously companies are going to cut back on expenses and stop offering jobs because they're trying to tighten up their accounts and weather the storm of the approaching recession. Now what you'll see what's going on here, this line right here is the start of 2020. So as I detailed in my previous market updates, we were already rolling over and into a downward trend on this chart, even before the COVID-19 really started to bite in February and March. But still, the total change in job openings has plunged an historic amount as well. So when you add all this up and we look at the employment to total population ratio, you'll see that these were previous periods of market growth. I guess really in 2000 we reached our peak employment, and since then we've been on a decline in 2007 and then the recent one. But now total employment to population ratio is just 51.3% of people with jobs. Now when you add some of those government adjustments to these numbers, this actually drops below 50%. So that's half of the whole entire US population is unemployed right now. So this does not bring good tidings as far as the overall economy. So looking at some of the broader measures, so this is on a year-over-year basis. Headline and core retail sales have crashed by record amounts. So, looking at these previous periods, here in the middle was your 2008 crash, and on the right-hand side, both of these measures, both the adjusted retail and food services sales, which is the red line, has plunged to historic levels. And then when you take out the auto dealers and building manufacturing and gas stations, it's still at this 10.6 level, still way below where we were in 2008. However, with all this lockdown and unemployment, one of the upsides, or maybe not so much of an upside, is this blue line. As gas demand has declined and plunged to these levels, the one thing that has been seeing an uptick in demand and price pressure is alcoholic beverages. So I guess with everything that's going on, people are turning to the bottle to deal with some of their fears and issues and problems that are going on in the world out there. Now getting into real estate, this is the SAR, total housing permits, which is your blue line. That's builders taking out permits to start building houses, and then the red line are the starts of construction of buildings. And you'll see this was a peak back in 2006. We crashed to 2009, and then we only got about halfway back to that previous peak on this most recent run. But as you see, everything's rolling over and plunging lower. So there is no sector out there that is not getting impacted by what's going on in the world today. And here is your existing home sale. So these are private owners who already, they're putting their houses out there on the market. And once again, you'll see a similar, even the existing home sales only reached, 2/3 of the way back to the 2006 peak before we've had this crash. So obviously with everyone on lockdown, no one can buy or sell their houses. So, the whole real estate arena is really been having some troubles, and we're not even getting into the commercial real estate arena where there are a couple of tranches of commercial backed debt securities that are being absolutely demolished as we speak. So there's going to be a lot more economic effects and knock-on effects as we continue to move through everything. But when we look at the total production of the US as a whole, you see this mid-trend line above or below where the zero baseline level is. But this lockdown has completely brought the entire US economy to a standstill. And the lack of production is worse today than it was in either World War II or even in the Great Depression. So we really are in unprecedented time and unprecedented events as we speak right now. So when you look at the industrial production compared to the actual Dow Jones Industrial Index, so the green line is your Dow Jones Industrial Index, the red line is your industrial production. And as you would expect, in the past, these two series have moved in sync with each other. But what you'll notice in this last financialized bubble is that industrial production really tapered off around the end of 2014, and we've sort of gone sideways ever since there until this big hit has come. The difference between actual industrial production and where the Dow Jones Industrial Average is, this is your financialized bubble. This is the disconnect between stock prices and economic reality. So moving on and how this is affecting the federal government. So what this is showing is your total tax receipts, total income, inflow of tax dollars and such to the federal government on a year-over-year basis. And you'll see we played with negative numbers back around 2015 and 2018. And now, obviously, this has plunged below those levels, and we're really getting back to previous levels where we have been in the midst of recession each and every time when we've hit these levels. So obviously, to counteract this, the federal government has had to go on a massive spending spree. And even though this has been an increasing level of total spending that the government has done over time, and obviously adding to the total national debt during it all, you see this spike right here, where normally they'd be doing $400 billion in annual spending, and they've spiked up to $1 trillion. And that's just in the span of a couple of weeks. But when you look at this on the full year of 2020, so this was done by Guggenheim, and you'll see the total treasury issuance or debt that's issued out there by the government in treasury bonds and such. And you'll see that the worst of times back here in 2009, we only got to about $1.5 trillion. For this year alone, we're looking at going about $5.2 trillion of additional treasury debt that's going to be issued out there to try and counteract everything that's going on right now. So when you look at this, obviously, if we don't have tax receipts coming into the government and the government's spending like crazy, then obviously that's what creates a fiscal budget deficit. Now, this series runs from 2011 up to 2020, and we want to stay away from politics altogether. But what you will see, obviously, Obama was running the country till 2016, and then Trump's been running it since then up to 2020. But you'll notice every single year, the country has been running a deficit. So it doesn't matter who's in power, obviously, we still seem to continue on the same course year after year. However, this red line, this is the anomaly of what's going on right now. And you can see just what an adjustment this is from other major, other years and deficit periods. So what does this all mean for the economy as a whole? So the Atlanta Federal Reserve puts out something called GDP Now. Now this is a real-time tracker of estimates of what they believe with all their inputs and where they see second quarter GDP going. And as of the latest estimate on May 19th, it's sitting at negative 42%. So this is, getting close to half of the overall economy or economic output just disappearing in the second quarter. So this is a massive hole that the US and our nation is going to have to dig itself out of moving forward. Of course, everyone's talking about, or used to be talking about, a V-shaped recovery, but if you've been listening carefully, that narrative has slowly and steadily been changing to an L-shaped recovery, or a W-shaped, or a U-shaped, or an inverted G. I mean, whatever letter of the alphabet you want to throw in there, everyone's changing their prognostications because that V-shaped recovery is not coming. So what's been driving markets up? So looking back over the long term, this is going back to 2003, you'll see that the red line, which is your global stocks, the blue line is global debt. So this is your yield on global debt. So as the stock market was rising up until 2007, global bonds were slowly selling off, which pushed their yield higher. And then when everything collapsed in 08, obviously people were buying bonds as a safe haven measure, which drove the yield lower as stocks crashed. But then things completely disconnected at that point. And as you see, sovereign yields have just continued to decline down, and we've seen negative yielding debt out there in multiple countries around the world, either through pure central bank easing and purchases that they've been doing, or by actual decree, like the Bank of Japan that set their rates at negative. But what's been driving stocks higher is global liquidity, central bank actions, all this stimulus and liquidity. And it wasn't just in 2007 when they started doing it. Their baseline of zero, they started after the dot-com crash, and it's been steadily increasing ever since and gone into hyperdrive to keep these markets afloat when they really should be, stocks and bonds should be interconnected and should be traveling in sync with each other if there was true economic fundamentals underpinning it all. So as far as what's been happening of late on this massive record-breaking rebound that we've seen, or dead cat bounce or bear market rally, is that millennials are buying like there's no tomorrow. Obviously, everyone's sitting at home, but it's so easy to go on Robinhood, open up an account, and day trade for yourself, because don't you know markets do one thing, and that's go up, and the Fed's there to protect us from any sort of crisis or downturn again, right? So there has been an historic 800,000 new accounts. Well, there is no history to this chart, but just over this period, 800,000 new accounts have been opened up on Robinhood with people doing their own day trading. So what this has now done, what we're looking at this chart now, with this rally that's occurred in markets, these charts are showing your P ratios, your price to earnings. So the green line is your technology index, and the blue line is the broader S&P index. So this was your February high when markets had just been, effectively we're in another tech bubble, just a reoccurrence of the 2000 tech bubble. But you'll see that their price to earnings ratio is pushed to cyclical highs on both the S&P and on the tech arena. Now, even though markets are still lower than where they were back in February, the actual price to earnings is multitudes higher. So markets are even more expensive on a price to earnings ratio basis today than they were back in the February bubble when everything went pear-shaped and fell apart. So these are by no means cheap markets, as a lot of people on television keep trying to say that, well, now's a wonderful time to buy because markets pulled back and everything's going to go higher forever. It's not the case. So should people be buying here? So what this is what's known as the Buffett indicator. Warren Buffett, one of the, or probably the best investor of our lifetimes. And what this does is it compares the US market cap, or the total valuation of the stock markets, compared to actual GDP, or actual economic growth and production. And you'll see right here, this was a dot-com bubble. the 2007 real estate bubble, and then where we are today. And after this rebound, obviously the economy's collapsing and the markets are going higher. So we've spiked right back up into this bubble territory where we were back in the dot-com bubble, and we've been in here in the last couple of years. You know, is this sustainable? Well, history says no. So moving forward, when you look at the US financial assets, you'll see that over the history, going back to the 50s, total US assets, financial assets of real estate and stock markets and everything else has tended to stay within a bandwidth of about 2.7 to 3.5 times the actual GDP of the country. And then back here in 95, when things started running into that first tech bubble, you see that markets totally disconnected from actual underlying economic fundamentals. So we've just had a series of financialized bubbles that have been blown each and every time. And right now, total US private sector financial assets are 5.5 times, 5.6 times what the underlying economy really is. So bigger bubble after bigger bubble after bigger bubble. And that's why I've been calling this the mother of all bubbles, because it's a bubble in everything out there. So now getting back to where markets are and what they've been doing, the green line on this chart shows the NASDAQ. This is your technology index. The red line is the NASDAQ consensus forward earnings per share. Now you'll see the two of them ran in sync up until we hit that February top, and then everything collapsed. Even though the central bank and the Robinhood traders and everyone else came out and added massive amounts of liquidity to markets, and markets turned and rallied higher, what do you see happening with the forward earnings? They continue to collapse and are barely starting to bottom right now. So there's this massive disconnect between fantasy in the stock market and reality of the actual earnings per share that's supposed to underpin the valuation of companies. And when you look at this on a total, instead of just the US, and you look at it as far as the overall global stock markets, you'll see a similar thing, that these two trended side by side. Obviously, with US markets running higher late last year, world stocks followed that trend, even though their earnings continue to be flatlining. So you already had a disconnect here, but then everything collapsed together. World stocks have rallied in sympathy with the US markets, while world earnings per share of all those companies around the world has plunged, just like they have here in the US. So globally, there's also this massive disconnect between where markets are and where actual earnings are. So one word of caution is what this chart shows. It's your small trader net bullish open option strategies. And you'll see you don't have to pay much attention to the past averages of this. But what you'll see here is we got this massive run up into that February peak before everything fell apart and went pear-shaped. And what do you notice where we are today? If you look real close, we're actually even higher today on this open option strategies than we were back in the February peak. So we've just taken a massive disconnected bubble from February and blown it even bigger once again. This is what the central banks do to markets and disconnections from realities out there. So be warned. If history is any sort of a precedent, then we're right back in getting ready for another collapse in the market. So here are some of the recent headlines that have, different articles and such. Warren Buffett, in his annual or in his quarterly investor review, he's back on May 3rd, he said that he had fully exited all of his stake in the 4 major US airlines and a lot of the hospitality and tourist sort of arenas. But also his F-13 filings showed that he had dumped most of his Goldman stake and also took big amounts out of JP Morgan. So he basically has been dumping airlines and banks. Everyone out there always talks about buy and hold. You should stay invested at all times. Warren Buffett does it, but the truth is, no, Warren Buffett doesn't do it. Moving forward, you've got Goldman. This was a recent report from Goldman Sachs, and they said that they see the S&P sliding back to 2,400 by August. They did say that they're viewing the market as finishing the year at 3,000, But between now and August, that's basically a 20% decline, and then they think there'll be another rally from there to get us right back where we are today by year end. However, just yesterday, Ford temporarily shuts down 2 plants just days after reopening because workers tested positive for COVID-19. And then there was another report from the University of Washington School of Pharmacy that has concluded that the number of Americans who will die after contracting the novel coronavirus will more than triple by year end. So I'm sure you guys have seen that the big Wall Street firms have also started putting out the assumption and these declining sine waves where we're going to have these periods of reinfection and lockdowns and reopenings and such. And with all that expected, it's definitely not going to be positive for the economy as a whole or any sort of a recovery, so to speak. So once again, markets are pricing things based on something in the future, not something that's happening today in the here and now. So speaking to that topic, Goldman Sachs just put out a report where they're saying that earnings per share on the markets they're unlikely to return to previous peaks until 2023. So between now and 23, does that sound like a V-shaped recovery? But down here on the right-hand side, you'll see that this is sort of their projection moving forward. But still, if earnings are based a lot lower, even in 2022 than where they were back in February, how can markets maintain these levels? But in other words, and this was from the report itself, it said, in other words, we've now teleported into some, quote, batshit insane world where one has to look at earnings 3.5 years into the future to justify current market valuations. Yeah, that's the absurdity of what is being sold to investors right now, is that everyone has to look through all the economic problems and issues and everything else and base today's market valuations on earnings that hopefully will be back to these levels 3.5 years down the road. And visually here, their earnings, the S&P earnings expectations, the red line is 2020, 21, and 22. So even 2 years from now, earnings 10% lower than where they were back in January or February. Actually, probably more so if they're saying it's going to be up 5. But once again, you get the point. If earnings are supposed to be the underlying metric of valuation for companies, and this is where their earnings are going, even on multiple years forward, then there's no justification for markets being where they are today. So, for all of you who have met with me before, you'll remember that I had said that when the bubble finally burst, what I was looking for was a 1929 style crash and a 1930 style global depression to truly wash out the system, get things back to economic fundamentals, and to, because we never dealt with the problems in 2008 because we bailed everyone out and took interest rates to zero so that all these zombie companies could roll their debt at zero cost. But so far, the red line shows the 1929 market and through to 1932. Now, these analogs, I mean, they're never perfect, they're never spot on. A lot of people like to use them, some people don't. But to put things in a relative perspective, if this plays out as a 1929 to 1930s downturn, then you'll see this series of lower highs and lower lows moving forward. However, looking at, so this is from Michael Markowski from Real Investment Advice. They're one of the people that I follow and read. But when they overlay the earnings projections and the decline of that period and mapping the same sort of decline in the S&P's earnings, what they're seeing is that the index will have declined by 85.3% when it reaches its final bottom. So they're projecting that basically the S&P could get down to 500 and lose 85% of its value if the earnings play out similar to what happened in that 29 to 32 period. So that's definitely not good news for investors and for the markets. But a different take on things, what this shows, the light blue line is the S&P 500 index year-over-year performance return. The dark blue line is your M2 money flow. And as you'll see, the S&P tends to track what the M2 money flow does. And just note this date, 20th of May. That was just yesterday. And what this is saying, you know, without reading through the whole thing, it said the S&P is set to peak around May 20th and then slump for the rest of the year before bottoming in early 2021, at which point the S&P will leave traders speechless and the bears steamrolled when the S&P explodes by more than 40% year over year as the Fed's liquidity tsunami finally makes its way into the stock market. So, you know, if this holds true, that means yesterday was the peak and we'll just see a declining market into year end and then a massive rally come early start of next year. But, you know, everyone has opinions and very few of them are right. So, but I like to look at things in economic reality and fundamentals. However, I am paying attention to this chart. I take a lot of different inputs into my overall analysis and how I look at the markets and how we do things. So no matter which outcome plays out moving forward, our clients are going to be okay. Because as you always hear me talk about, we invest for growth, but we also mitigate losses. And if we do that, then returns will take care of themselves. So this is our conservative total return income fund. And we compare against the Value Line Geometric Index, which is your broad US equal weight market index. And it represents what your average investor's portfolio performance would be. So this was the 2018 drop, and this is what the markets just experienced recently. So our conservative fund is up 7% with markets down 28% from start to finish. So our conservative fund is beating the broad US markets by 35%. When we move to our Global Opportunity Fund, which is our moderate fund, same time frame and comparative, it's beating US markets by 31.25% because we protect from those losses. Our aggressive 100% US equity fund, we started this exactly 1 year later in mid-2018. Obviously, we avoided the drop in 2018 and then we got the growth, avoid the drop, get the growth. But this one really shows you the stair-stepping pattern of how the strategy works. And we add growth on top of growth on top of growth, while at the same time mitigating the downturns and protecting from those losses and effectively, you know, holding on and preserving our clients' wealth and their capital. And then when markets do turn, we get reinvested at that next low. But that's a 45% beat. Similarly, the International Equity Fund, same period, that's only 31.74% beat against US markets. But international markets have been struggling for a long time. They haven't had the same upflows as the US markets have. And then the last fund is our long, short, or weather fund. So this one is where we are specifically shorting the US markets and we're long in commodities and precious metals and Bitcoin. And this one is a go anywhere fund and it's contrarian by nature. So this one is always looking for where the next value opportunity for investment is. So at some point, you know, I'm looking for another leg lower in markets, and at some point when markets have declined enough, then the shorts will have served their purpose and this fund will recalibrate and look for where the next opportunity for growth is. But as you see, when markets collapsed, this fund spiked higher, and at its peak, that was a 70% beat head to head. With this rally in the markets, obviously this one has pulled back, but now we're starting to turn. And as we move into the next downturn, we'll see this fund turn and run higher and take advantage of that downturn. So we help everyone at all levels. Literally, our smallest clients could be someone with $6,000 in their first contribution to an IRA account. But you know, we help everyone from no limit to sky's the limit. Individuals and families, nonprofits, foundations, closely held businesses. You have private companies with their corporate accounts, their pension plans, their 401k plans. If it can be invested, we can manage it and apply our methodology and our funds to it, even 401k plans, which no one else out there is doing. So we're here to help everyone at all levels. Here's our contact information, my email address, my cell phone number, and then the website where our performance charts are posted. We update those on a weekly basis, so you can always keep an eye on how the different funds are doing. And then also we post under the blog tab is where I put my written market updates, and we will be posting this video moving forward with our mid-quarter market updates. We'll be posting those on the website and also out there in the world as well. So thank you so much for joining us. If you have any questions or anything you'd like to discuss, or you want to dive a little bit deeper with any of the things we covered,